A few days ago, a client contacted us through our media platform, insisting on visiting the office to talk in person. I said to him we usually only meet with members offline. I was surprised that he immediately paid to join the Vision membership and arrived at my office that afternoon. We had a great chat. He came from Beijing, China, just got his permanent residency, and had a considerable amount of spare cash to invest. He was torn between investing in stocks or residential real estate and asked for my opinions. Well, that's a great question. The Australian government is a bit crazy on financial advice, so I said, first of all, I won't charge you for my opinion on share investment. Second, we need to get out of the office and talk over coffee casually. And thirdly, please don't listen to me, pay a professional for formal advice. He said no problems. The recent frenzy in the stock market is well known, especially with Australian stocks rising 15% and US stocks 32% over the last 6 months. Some stocks like Nvidia surged by 131%. Many new investors, including real estate investors, are beginning to wonder whether they should invest in stocks or real estate. After chatting with him for nearly 2 hours, I helped him clear his thoughts and plan his real estate investments. So I'll share with you the differences between buying real estate and stocks in Australia, and under what circumstances and for whom each investment is suitable. This is not financial advice to anyone who watches my video. Hi, my name is Alex. Welcome to Oz Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Number 1, capital gain. Whether it's stocks or real estate, the most profitable aspect is the price increase, known as capital gain. How much can it increase? The average annual growth rate of Australian residential property prices over the past 25 years is about 7%, while the long-term annual growth rate of the US stocks S&P 500 index is around 10%. Let's compare the future capital gains of both. If you buy a property in Sydney worth $1 million today, it will be valued at $5.43 million in 25 years. If you buy US stocks worth $1 million today, their value in 25 years will be $10.8 million. But don't rush to a conclusion just yet, as there are many other factors to consider. Number 2, cash flow. Besides price appreciation, real estate also generates rental income. According to CoreLogic's February report this year, the rental yield for Australian residential property in Sydney is 3%, in Darwin it's 6.6%, and the average across the 8 major cities is 3.7%. That's $37,000 in rental income per year for a property worth $1 million. On the other hand, the cash flow from stocks comes from dividends. Taking the S&P 500 index fund as an example, which includes 500 of the top listed companies, each with its dividend policy and ratio. The S&P 500 index's dividend is calculated based on the proportion of each stock. The average dividend yield since the inception of the S&P 500 index has been 2.9%, which has been declining over the years, dropping to 1.78% in 2022, with a clearly decreasing trend. Let's assume an average dividend yield of 1.7% for the next 25 years. That's $17,000 per year. Number 3, purchase costs. Regarding the cost of buying, Australian real estate requires the payment of legal fees, stamp duty, and some miscellaneous expenses. Legal fees are approximately $2,000, and stamp duty varies by states and territories, but is roughly 4%. They are all one-time expenses. For instance, in New South Wales, this part of the one-time purchase cost is about $42,000. The situation with stocks is different. For someone in Australia looking to buy US stocks, you need to first open an account with a broker, such as one of the Big Four banks' securities departments, then deposit funds, and finally purchase stocks. When buying, you need to pay a transaction fee and a currency exchange fee from Australian dollars to US dollars, totaling $6,700. Of course, the securities departments of the Big Four banks are not the cheapest regarding fees and currency exchange. They're just more convenient because you likely already have an account with one of the Big Four, making the operation much easier and giving you peace of mind. Number 4, holding costs. The holding costs of real estate are more varied, including water, council, property management, maintenance fees, etc. If holding real estate results in a net loss, it can offset personal income tax for the year. If profitable, it needs to be reported together with personal income tax. Without a loan, Australian real estate will definitely generate positive cash flow. With the rental yield of 3.7%, the actual net cash flow is about 2.7%, with expenses around 1%. On the other hand, holding stocks incurs almost no costs except for the dividend, which is taxed at 15% by the US government and then taxed according to Australian personal income tax. However, due to bilateral agreements, there's no double taxation, so the total tax paid is ultimately personal income tax, which we assume is at a 37% rate. Number 5, selling costs. The costs of selling real estate are essentially renovation and agent fees. How much renovation costs depends on the specifics, such as whether it's a major project like painting walls and replacing floors, or just a minor cleanup. Agent fees generally range from 1.65% to 2.2%. After selling stocks, the money returns to an Australian bank in Australian dollars, just like above, at 0.67%. But charges from intermediary and custodian banks depend on the specific circumstances. Number 6, taxes. In terms of taxes for Australian real estate, the first is income tax. Essentially, it's income from holding real estate. For example, rental yield minus all expenses such as the holding costs mentioned above, agent fees, and Australia's unique negative gearing. Whether profit or loss all have to be included in the calculation for the year's personal income tax. We'll assume a personal tax rate of 37%, but even if you generate income, you can't invest this money back into the property to generate a compound return, so it doesn't affect property appreciation, at most providing some extra pocket money. For US stock dividends, you first pay 15% to the US government, and the remainder is included in the Australian personal income tax for the year. Considering a personal income tax rate of 37% and the compound effect of reinvesting dividends, stocks worth $1 million after 25 years will be valued at $13.8 million. So after calculation, in the example above, $1 million in Australian real estate versus $1 million in US stocks over 25 years, the annualized cash-on-cash return rate for Australian real estate is 6.7%. While for US stocks, it's 11.08%. US stocks clearly wins. This does not take into account capital gain tax after selling, inflation, various tax planning factors, etc. It's just a comparison of the net cash-on-cash return rate before selling expenses and capital gain tax. Some might already be concluding that US stocks clearly wins, but hold on, there's a very important and often overlooked factor not yet considered: leverage. In a sense, leverage means loans. In Australia, buying a house typically involves taking a bank loan for 80% of the property's value. Calculated at an average long-term loan interest rate of 5.5%, paying only the interest without repaying the principal. Assuming all that, in the same example, using $200,000 in cash and $800,000 loan to buy a $1 million property with all other conditions remaining the same, the annualized net cash-on-cash return rate before selling costs and taxes over 25 years increases to 12.71%. The reason is that with just $200,000 in cash, you control a property worth $1 million. The appreciation of the property is calculated based on the $1 million. Thus, the cash return rate calculated on the $200,000 is significantly higher. Of course, if you use $1 million in cash to control a property worth $5 million, you could earn even more money. Well, this explains why Australians prefer to invest in residential real estate. At this point, you might think that Australian real estate, with the leverage, has completely outperformed US stocks, but it's not that simple. Aside from the return differences, many factors can affect an individual's psychology, which in turn affects decision-making and ultimately investment returns. Other factors. These factors vary but mainly relate to personality, task approach, and risk tolerance. Number 1, complexity of procedures. Buying, holding, and selling a property are all time-consuming processes. Although one can delegate all these tasks to a real estate agent, only a minority are willing to spend the money, especially when it comes to purchasing. In reality, most people prefer to be hands-on. Inspecting properties can sometimes be a pleasant experience. When managing a property, you need to communicate with rental agents, and selling requires interaction with sales agents, which many find bothersome. Stocks, however, are different. Once you've chosen a good broker and stocks and set your investment plan and automatic transfer settings, you only need to check the mobile app every 3 months. Please note that I'm referring to long-term index fund investments, which are not applicable to day trading. Number 2, methods of buying and selling. Unlike real estate, stocks can be bought and sold in portions. If you've made a considerable profit, you can plan to sell more stocks in years when your income is lower to reduce income tax. You can also choose which stocks to sell, making the process very flexible and quick. Real estate doesn't work the same way. You can't sell half a house and keep the other half. How long it takes to sell depends on the market, making cashing out harder. Number 3, tax impact. Tax considerations for real estate and stock investments, tax reduction strategies, and tax structures are complex. I suggest consulting a professional accountant for detailed advice. To give you some hints, real estate allows for depreciation, but stocks do not. Real estate enjoys a capital gain tax exemption for primary residents, which stocks do not have. Both have a 50% capital gain tax discount. If you buy Australian stocks, you'll encounter a tax system called franking credits. In terms of tax structures and exemptions, Both types of investments have their advantages and disadvantages. Using family trust and self-managed super funds for investment to achieve growth and tax minimization is a completely different area. You can discuss with a financial planner on this topic. Number 4, individual real estate versus average stock market. Investing in real estate can't be fragmented unless you own 100 properties of every variety, so you generally can only choose a single property, similar to picking individual stocks. For the average person, this is riskier than buying a broad market ETF. That's why you need a professional team to help you. Number 5, risk. The stock market is risky, enter with caution. While this is true, it only applies to those who don't understand the stock market. Real estate investment is no less risky than the stock market, just in different ways. Stock prices fluctuate more rapidly, while real estate prices move slower and are harder to sell to stop losses. If property prices fall, interest rates rise, and you lose your job and can't pay the mortgage, you might be forced to sell at a loss, turning paper losses into actual ones. On the other hand, selling a house is more troublesome. It inadvertently increases the average holding time of the asset, making this investment long-term. Many wish to take a long-term view of the stock market, but not everyone can withstand the psychological impact of price volatility. Selling stocks is as easy as pressing a button, and many selling in panic, ending the compound effect and significantly reducing long-term returns due to human factors. So is investing in real estate better than in stocks? If we set aside personal biases that lead to operational mistakes and just look at the return rates, stocks are actually a better investment. However, once leverage is factored in, real estate investment significantly outperforms stock investment. So the key factor in deciding whether real estate or stocks is the better investment is leverage. Having discussed all the above points, let's have a quick conclusion. Without leverage, investing in US stocks is better. But remember that there are personal factors to consider, like the barrier to learning financial investment or the fear of stock market risks. The ease of liquidating stocks also means that in times of panic, paper losses can quickly become real losses due to hasty selling. This is where psychology plays a crucial role, so a strong mentality is essential. With leverage, investing in Australian real estate is better. However, be aware that real estate is less liquid and requires a long-term commitment. The benefit is that in a downturning market, the difficulty of selling reduces the chances of panic selling, effectively making real estate a medium to long-term investment by default. So real estate investment doesn't demand as much psychological resilience, and being tangible, it is easier for the average person to accept. Real estate investment, at its core, is a financial investment, just like stocks. So the only difference is that between you and the rich version of you, is it stocks or properties? If you've just started working towards saving for property deposit, but don't have much saved up yet, investing in stocks is one of the better options at this stage. If you have enough for deposit from stocks and cash on hand, and you're capable of securing a loan, don't hesitate, buy a property. With mortgage interest rates below 7%, and if the cash flow can cover the mortgage while still having cash reserves, it might be better to invest in the stock market, especially when the interest rates are very low. On top of that, if the Australian dollar is strong against the US dollar, you might also profit from the exchange rate. For new immigrants to Australia, buying a house to settle down first is better. If you have more funds, maximize your loan, diversify properties across different states and territories, then gradually learn about financial investment and explore the stock market. This is a healthy investment approach since real estate is tangible and understandable to everyone. In my own portfolio, most of my assets are in Australian real estate, with a small portion in ETFs and some spare cash in individual stocks and cryptocurrencies waiting for a jackpot. For me, this is an optimal mix because I specialize in real estate investment, enabling me to manage cash flow and risks effectively. The ETFs are where I park funds that I won't need for a long time. The small amount in individual stocks is because I don't have the time to analyze companies and industries' prospects, so I treat it as a gamble. Winning brings joy and losing isn't a big deal as long as most of my assets provide a steady return on investment. The above is just my personal opinion, not financial advice. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. Have a good one. Bye.